Hello, my name is Carol Sofia Saavedra Villarreal, and today I am going to explain how asset, liability, and equity accounts work and how data is recorded in each one. Let's start with the 5 asset accounts. Explanation of asset accounts. What are assets? Assets are all the goods a company owns that generate future benefits or income. They can be tangible, like a building, or intangible, like a patent. Type of asset example: current asset cash, banks, accounts receivable, inventories, non-current asset machinery, land, buildings, vehicles, intangible asset trademarks, patents, software, copyrights. 1. Banks. This is a current asset account. Its main function is to control the money the company has deposited in its bank accounts. It records income, such as deposits, received transfers, or customer payments. Since it's an asset account, it increases on the left side, debit, and decreases on the right side, credit. When money enters, e.g., a customer pays via transfer, it is recorded on the debit side because the account increases. When money leaves, e.g., payment to suppliers, it is recorded on the credit side because the account decreases. 2. Cash, caja. This is also a current asset account that represents the cash, bills, and coins the company has on hand. This cash is immediately available to cover expenses or make small payments. Difference from the bank's account. Cash records cash operations, like cash sales, petty cash expenses, while banks records bank account movements, transfers, checks, deposits. Both increase on the debit side when money comes in and decrease on the credit side when money goes out. 3. Recoverable VAT, IVA accreditable. This is the VAT the company pays when purchasing goods or services. This VAT is not an expense because the company has the right to recover it against the VAT it charges customers. How does it work? When you buy something with VAT, that VAT accumulates in the recoverable VAT account. When filing tax returns, this amount is subtracted from the VAT charged to customers, known as transferred VAT, and the difference is paid to the tax authority, SATI. 4. Inventory, almacén. The inventory account is a current asset that represents the value of the merchandise the company has available for sale. Purpose: records and controls inventory of goods not yet sold. Tracks incoming, purchases, and outgoing sales merchandise. Helps calculate cost of sales and inventory value at period end. Shows how much capital is invested in merchandise. How are transactions recorded? Using the perpetual method, all entries and exits are recorded directly in the inventory account. It increases when goods are received and decreases when goods are sold. Example: sale of merchandise. 2 entries are made. 1 for the sale, revenue. 1 for the inventory leaving, cost. 5. Insurance premiums. Insurance premiums are payments a company makes to an insurer to contract insurance, e.g., for vehicles, buildings, liability, etc. Purpose: they protect the company against possible losses or risks, theft, fire, accidents, etc., in exchange for a premium. How does it work? When premiums are paid in advance, e.g., yearly, they are not immediately recognized as expenses. Instead, they are recorded as an asset, and a portion is then recognized monthly as an expense. 5. Liability accounts. Explanation of liability accounts. Liability accounts represent debts and obligations the company has with third parties, i.e., payment commitments that must be met in the future. Accounting definition: a liability is a current obligation of an entity arising from past events whose settlement is expected to result in an outflow of economic resources such as money, goods, or services. Liabilities increase on the credit side and decrease on the debit side. 1. Accounts payable, proveedores. This account represents debts or obligations with third parties for purchasing merchandise on credit. When you buy something and don't pay immediately, the amount is recorded as a debt in this account. Functions: tracks debts to suppliers for credit purchases, helps know how much is owed and to whom, reflects short-term obligations in financial statements, records payments when debts are settled. Transaction side: what happens purchase on credit increases the liability, payment to supplier. Debit decreases the liability, return to supplier. Debit decreases the liability, discount on purchases. Debit decreases the liability. 2. Notes. Payable, documentos por pagar. This account records the company's debt supported by a formal document like a promissory note or bill of exchange. Purpose: to maintain an orderly legal record of the company's financial obligations, especially those that are formally documented. 3. VAT collected, IVA cobrado. This account registers the VAT the company charges to customers when selling taxable goods or services. Functions: tracks amounts owed to the government, shows how much VAT has been collected and must be paid to tax authorities. Legal compliance: required to maintain a clear record of VAT collected. Example: sell a product for $10,000 plus 16% VAT, $11,600. Debit: customers or banks receiving money. Credit: sales, recording revenue. Credit: VAT collected, you're receiving tax money for the government. 4. Dividends payable: used to register the obligation to pay dividends to shareholders after they've been officially declared. Purpose: to record the amount of profit distributed but not yet paid to shareholders. How it works: dividends are approved in a shareholder meeting. The obligation is recorded even if not yet paid. Once payment is made, the account is cancelled. 5. Other creditors, acreedores diversos. This is a current liability account that represents debts to third parties, not related to merchandise suppliers or banks. Purpose: records debts from non-core operations, such as loans from partners or individuals, not banks, pending professional service payments, miscellaneous services not part of core operations. 5. Equity accounts. Explanation of equity accounts. Equity accounts represent the resources belonging to the owners or shareholders of a company. It's the residual value of the company's assets after subtracting its liabilities. Main functions: reflect shareholders' contributions, include retained earnings, accumulated profits, affected by losses, withdrawals, and dividends. 1. Capital stock, capital social, represents the value of contributions made by shareholders when the company is formed or when capital increases are made. It's the base capital of the company. Functions: record shareholders' contributions, financially support the company, fulfill legal requirements, determine ownership percentage. 2. Legal reserve, a portion of net profits that the company is legally required to retain and not distribute to shareholders. Purpose: to build a mandatory reserve fund each year to support financial stability. Usually, 5% of annual net income is allocated until the reserve reaches 20% of capital stock. It is a credit nature equity account. Its creation reduces the profits available for dividend distribution. 3. Cost of sales represents the cost of the products or goods sold during a period. It's not the profit. It's what it costs to generate that revenue. Purpose: to calculate gross profit, sales, cost of sales, to reflect the real cost of generating sales in the income statement. Although it's a cost, it behaves like an expense. It's a debit nature account, classified as a result account, and appears in the income statement, usually right after net sales. 4. Financial expenses. This account records all costs related to using borrowed money, such as interest on loans or credit lines, bank commissions, exchange rate losses, discounts for early payment in some cases. Purpose: shows the cost of financing with external money, affects net income, appears after operating income, supports decision-making regarding debt. How are transactions recorded? When a financial expense is incurred or paid, it is debited because it reduces income. 5. Selling expenses. Also called marketing expenses or sales operating expenses, this account records all costs related to selling a product or service after it's ready for sale. Purpose: to determine the full cost of selling beyond production or purchase, to calculate operating profit in the income statement, to evaluate commercial efficiency, to separate sales expenses from admin or financial expenses. How is data recorded in the selling expenses account? Every time the company incurs a sales-related expense, the sub-account is debited, and the account that pays or records the debt, such as banks payables or salaries payable, is credited. This concludes the explanation of all the accounts. Thank you.